Audio Jungle.
7 rules to win in the stock market. I think even the least financially educated person can tell you that in the world of investment, there is no name more impressive than Warren Buffett. I mean, all you need to know about the guy is that if you had ever invested $1,000 into his company when he bought it in the 60s, that 1,000 would be worth $30 million today. And while many people call him a magician for that level of consistent success, Buffett himself has always been open about the secrets that he uses to win in the stock market. And as it turns out, even we Indians can use those billionaires' rules to win in our country's growing stock market. So, if you are curious to learn about these rules, you are in the right place. And I hope you watch till the end because the last rule on the list is the one that makes the difference between common businessmen and the likes of Buffett. And so, without any further delay, here are 7 rules to win in the stock market. I think I speak for the majority of the viewers and the people in their social circles that to most of us, the stock market has always been a mystery. We see the bright green and red graphs, the endless rows of digits and the thousands of tradable stocks and decide कि मेरे बस की बात नहीं. But it is that way of thinking that keeps so many of us from being able to understand it in the first place. You see, the secret behind most stock market gurus is not that they understand something super difficult, but that they make you. And I think that a simple and easy to learn thing is difficult. So we don't even think about encroaching in on their territory. When in reality, all you need is some courage and just a couple of good ideas to turn the stock market into your playing field. And that is where Buffett comes in. You see, after having spent more than 8 decades in the stock market, he has realized that you don't need a degree or a massive list of principles to make it in the investment universe. Instead, all you need is, as he puts it, 3 or 5 or 7 good ideas to make you wealthy. And luckily for us, he has shared those ideas with us for absolutely free. So let's explore them one by one, starting with rule number 1, the value of intelligence and integrity. One of the things any person hoping to make it in the stock market will have to face will be the decision to work with other people, be it business partners, contractors, stockbrokers, or employees. If you want to become successful sooner or later, you will have to start to deal with these peoples. And one of the biggest reasons that people who showed promise in the beginning end up losing money just as they start to get big is that they don't know what to look for in a person whom they are going to be working with. Luckily, Warren Buffett has devised a short but strict rule of thumb for selecting just that. As he once told to a class of business students, you are looking for 3 things generally in a person: intelligence, energy, and integrity. And if they don't have the last one, don't even bother with the first 2. And while first 2 are obviously important, because without intelligence they are going to be wasting your time and effort, and without energy whatever skills they may have will go to the waste. It is the last point which is most important, because as Warren Buffett explains, without integrity, any skills and work the person will have will be used not to help you, but to further their own ambitions at your disadvantage. That is why it is crucial to only work with people that don't waste your time, but also are not out to get you. Now, on to more investing specific advice, we have rule number 2. Facts will always triumph emotions. It is pretty commonly told that investing is a market that is shaped by the market's emotions. And as far as the fluctuations in stock go, that is definitely true. But where emotions don't matter is the decisions you, as an investor, are going to be making. Here's what I mean. According to Buffett, one of the consequences of the stock market's volatility is that when times are good, people start to assume that the profit they made happened because of their natural skill level, which in turn makes them cookier and more careless. And as a result, when the market does start to falter, instead of taking a look at the facts and deciding to slow down, they continue to trust their hunches and end up losing more money that they made when times were good. This also goes the other way, where sometimes the conditions are right, but people, due to the anxiety shown by other investors or due to their own bad luck over the past few months, decide to not invest just because of their own fears. This is why one of the first pieces of advice Buffett gives to his employees is to make quantified investment decisions based on the math and the facts of a business compared to the stock price, not your own emotions of fear or greed. Speaking of betting on math, not on emotions, another subtle but important rule that Buffett holds there is rule number 3. Don't buy cigar butts. One of the often quoted pieces of advice attributed to Mr. Buffett is that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But the thing is, very few people actually know what it means. So let us explain. You see, one of the most common tricks that are taught to new investors is to use their money to invest in companies that are almost at a verge of death for an extreme low price. Then, once it's just a little bit better, you sell it for a sharp and easy profit. This practice is known as smoking cigar butts, basically saying that investors go around looking for discarded pieces of once good companies to get cheap profits, or in other words, looking half-smoked remains of a cigar to take a free whiff just for a few minutes. But according to Buffett, while that policy is fun in the short term, you are far more likely to generate a good profit if you just put your money in a good stock that might not be super cheap but also isn't super bloated to draw out a genuine profit in the long term. That also ties into the next rule about being smart and calculating. Rule number 4. Only invest in what you understand. One of the most important investment concepts that Buffett likes to teach his students is something called a circle of competence. And according to Buffett, knowing what it is and how to apply it makes the difference between an amateur and a professional. As for what it is, who better to explain it than Buffett himself? In the investment guru's word, I have an old fashionable belief that I can only expect to make money on things that I understand. And when I say understand, I don't mean to understand what the product does or anything like that. I mean understand what the economics of the business are likely to look at like 10 years from now or 20 years from now. This understanding of a product's nature and the ability to know and be able to predict its behavior is what Buffett calls his competence with the stock. And any company that falls inside this circle, or in other words, any company that Buffett is confident he understands, he will invest in. By comparison, if there is a stock that has a great ideal of market momentum and everyone is making a ton of money off of it, if Buffett thinks that he doesn't understand the stock and the company's nature that well, he will never bet his money on it, no matter how attractive the numbers look. As he once told interviewers, know your circle of competence and stick within. The size of that circle is not very important. Knowing its boundaries, however, is vital. Rule number 5. Don't be afraid to be an opportunist. Now, I know we just mentioned how one shouldn't be too eager to jump into something just because times are good there. But that is in the case of stocks that you don't understand. By comparison, if there is a stock you are familiar with and it is doing really well, According to Buffett, if you don't go all in, then you may regret it for the rest of your life. As he warned students during a lecture, the biggest mistakes I have made by far are mistakes of omissions are not commissions. I mean, it is the things I knew enough to do with. They were within my circle of competence and I was sucking my thumb. And then explains that just like in the world of business, there were big opportunities in life that have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we have got to do it. And the same rule applies to holding stocks. Rule number 6. Don't sell unless the world changes long term. Buffett had said many times that quote, "One favorite holding period is forever." But there is more to that statement than being easily quotable. You see, one of the biggest misunderstandings that people who get into the stocks business face is that they try to use stocks as a short-term money-making tool, when the best way to make money off stocks is by waiting in the long term over decades, not months or weeks. And even people who understand these distinctions still fall to the same mistake of selling good stocks due to fear of short-term losses. When they see a stock that they have been holding for a long time start to struggle. You see, in that situation, according to Buffett, unless there is a fundamental change in the stock category, like the introduction of new technology or a big shift in management, no matter how bad a stock does in the short term, you have to remain confident and continue holding it. And that finally brings us to the last and the most important piece of Warren Buffett's advice, the thing that made him as rich as he is. Rule number 7. The principle of intrinsic value. In this video, we have talked a lot about some of the misconceptions surrounding stocks that prevent us from making a profit, but none of them compare to the concept that making money through stocks is done by predicting the rise in the stock's value. That's right. According to the single biggest investor in the world, the only way to properly invest in a business is not in terms of how well its stock will do, but in terms of the value that the business itself will provide. Or in other words, it is not about the stock value of the company, but its intrinsic value. This is the value found in the business's products, practices, and employees. And according to Buffett, people who look for businesses that perform well as businesses will make far more money in the long term than those who invest in businesses whose stocks perform well. And that wraps up our list of the 7 rules to win the stock market. But before we end the video, we would love to hear from you about what you think is the more important strategy. Being confident is your choice or taking more risks? Do let us know in the comment below. And with that, we must end the video. I hope you found it helpful, and if you did, please be sure to leave a like and subscribe to get more content like this delivered to your doorstep.